Good morning to everyone. I hope you are all well and, like always, ready to take a course of today. I welcome you all to yet another session of financial reporting on Saturday. Coming into a live course each time now has become a part of our life, as we today are meeting for seventh time. I hope at your side, you people are quite used to of the way coming into each time into a live session and see me working the new stuff. And then later, the way the resources that you get in terms of board works, in terms of recordings, always well on time. And I hope you people are also making the use of it, not just I have been providing you with all that stuff and you at your side are happy by just keeping it, not even using it. So I hope at your side, you people are getting the benefit out of those things. Those are the value added features of this course that you have opted. So the last time we were in discussion of chapter 7, a chapter on impairment loss. We've spent the whole time on. We even have finished. We have done some questions in the last. Nothing is still there to work from, as that topic was fully finished with all the required exam practices that I could possibly do. I have. We're starting off with a new topic, entirely a new topic today, which is on lease, chapter 8. Big chapter, will not be finished today, will take a bit of a time. So I'm starting it off today. We'll be able to complete it by 80-90% of it today, while the little part that will be left out, expect to finish it the next week. So I hope by this time, most of you have joined in and I can connect to the board to start having a word. Chapter 8 is the one for which you have not been provided with the summary, like the way usually we have. Rather, I have been able to prepare the notes pre-written in a summary way, which in fact will be the explanation of the course of today and the summary in the other words. I'll be doing a lot of stuff onto this file by myself into live course, lots of examples, I will work, lots of things I will go to write, but the major content, I already have been able to write it in a summary manner. So the same handout will be a summary for you and also your board explanation, which later on you will get the access to it always like the way in the past, the PDF manner. And that's the detailed notes that we know that we always concentrate on in practicing the questions from, and even I try to always show to all of you the way things are written, the way they're back into lecture notes, which is something that I don't have to say because you people now have become quite used to the way that I conduct courses. So I don't really have to say what I do, which you already have experienced it out in the past 6 sessions, the way that I conduct the course. I take the course first and then followed by some learning examples from lecture notes. And then once the topic finishes off, we go straight away into exam kit to practice the objective test questions from. So let's put this lecture notes aside. Let's concentrate on this file, which is the one I have prepared it for you in a friendlier manner that you will find it a lot easier to understand. A difficult topic of this kind will become a lot interesting and easier, I hope. As far as the importance of the standard is concerned, it's highly important, both for your exam and even the practical context. Never in the life you have seen the accounting of leasing at any platform. You will see it for the very first time by taking the course of financial reporting. It's so exciting. If I share you, if I'm in your place as a student, I always will feel excited coming into a course and learning new things, because I'm an accountant, so I should be eager to learn newish accounting aspects that never in the life I was aware of. When I even started this course, 7 sessions ago, 6 sessions ago, I told you that, look, don't target this course to prepare it just for you have to pass the exams for 50 marks. Also, consider it to be as a course based on which you will get a lot of knowledge, which by an accountant will be very much fruitful for your life to apply into practical situations and everywhere you work, being an auditor or being the financial consultant. Never in the life you have studied the accounting for leasing. For the very first time, you will get to know by taking the course of financial reporting. So with all the theme has been set up, let's get on with this. A definition of lease, I have been able to place it in front. You can look into that picture first. The definition, you will be able to automatically understand. See what's happening. There are two companies, APLC and BPLC. Clearly, you can see me demonstrating APLC is letting an asset out to BPLC and BPLC starts paying the rentals over to. So it's a contract in between two of the parties. They have an agreement in between whereby one of the party gets the use of asset by making the payments of rentals. This is simply called as lease contract, a contract by which one of the party gets the use of asset by making the payments of rentals to another. The asset is not being purchased. The asset has not been sold, rather being taken on a rent. In simple words, the asset is taken on a rent. So the one who pays the rent gets the use of it, while the one who receives the rent is the owner of it. This party owns it, this party only uses it. The ownership can pass on to this party at the end of the contract, but for the whole of the life of the lease, APLC will be the owner, BPLC will be the user. Once the contract expires, the ownership may be passed on to B or may not be. What happens throughout the life, I have explained. APLC will be the owner, BPLC will only be the user. By paying the rentals to APLC, A will continue to use. In other words, APLC giving a permission to BPLC to use its asset. Whose asset is it? APLC. So APLC permitting, allowing the BPLC to use its asset just because they agree to receive the rentals for that use. That contract is simply called as a contract of lease. So the one who owns an asset, leases an asset out is called as lessor. To whom an asset is leased out is called as lessee. In such clearer words, I have been able to say the one who leases an asset out is called as the lessor. An owner. To whom an asset is leased out? The user, the lessee. We will have to go and understand the accounting of lessee, as this one is only examinable. Examinable in FR. Examined in FR. This one is only examined in FR. You will not be asked from the perspective of lessor. You will see the same thing in SPR. If you will come to see me in SPR, Strategic Business Reporting at level 3, next session, or even a session after, there you will come to see me explaining to all of you the lessor's perspective, which is not examined in financial reporting course. Only the perspective of lessee will be examined. because that's the part of our syllabus. So we will be concentrating. Even that to understand, I told you will take the whole course of today, even the next time, because that's too big. That's what I write it even of a contract by which lessee gets the use of asset by making the payments of rentals to lessor for an agreed term. That agreed term is called as lease term. So you don't really have to cram it. You just need to understand the whole arrangement. That okay, the lessor has to pay, the lessee has to pay rentals to get the use of asset for an agreed period, say 5 years. That's 5 years called as lease term. So asset being taken on rent, not being purchased. The lessor will be the one owning an asset and allowing the lessee to use an asset, because the lessee in return has been paying the rentals over to it over the life. Let's try to extend our explanation towards lease term, because now we know who is lessor. The one who leases an asset out is called as lessor, who owns an asset. And we also know his lessee, to whom an asset is leased out, being the user. We just need to understand this lease term. What is lease term? You do not have to do any efforts, because you have got the efforts being done by me. You just have to get the copy of that coming to your side and access it the way it's being written. Just try to concentrate on every bit of that's going on as far as the concepts are concerned, as far as the computations are concerned, the presentations are concerned, the double entries are concerned. Your job is just to fully concentrate over. No need to write anything at all. Non-cancelable period for which the lessee has been granted the right to use it by the lessor. Non-cancelable means this period of lease cannot be terminated. It's a non-cancelable period for which the lessee has been granted a permission to use it. I told you before, it's a permission. The lessor is granting to lessee to use an asset. So that period for which this permission has been granted for, that period is said to be as the term of the lease. Also can be called as basic period of lease, because you could have some more periods coming into, including the period of extension, including the period of termination. I can come to explain what is it. Non-cancelable period is the one which cannot be cancelled, which cannot be terminated, for which the lessee has been granted the right to use it by the lessor, including the period of extension and period of termination. Okay, see this example where I can make one case down below where A Limited takes an asset for a 5-year lease. The lease agreement allows A Limited to extend the lease term, for next 3 years. A Limited to extend the lease term for the next 3 years. A Limited takes an asset on a 5-year lease. Lease agreement allows A Limited to extend the lease term for the next 5 years. So this 5-year thing is a basic contract life. I can write it to be as this 5-year thing is a non-cancelable period. I can call it to be as non-cancelable period. Non-cancelable period, where the 3 years in it are the period of option to extend period. Option to extend period. These 5 years are not going anywhere. This is definitely going to be the life of contract, at least 5 years. But to include this 3 into it or not to totally depends upon the expectation of lessee, what the lessee believes in. So in my example, I can suppose the lessee is likely to extend. So if the lessee is hoping to extend, if the lessee is likely to extend, the contract life is going to be what then? 8 years. 8 years has turned out to be the term of lease, has turned out to be a lease term, has turned out to be a lease term. Because even if you think commercially, if the lessee is expecting to extend the contract for 3 next years, then the lessee is wishing to use the same asset for 8 years. So that's useful to lessee then, 8 years life. So option to extend will be added into the basic period when the chance of extension is likely to be there. This is what I write it over there. The chance of extension likely to there. Yeah, if the lessee is not likely to extend, then the lease term will only be 5 years. If I change this word to unlikely, then I will not include this. I will be calling the contract life to only to be 5 years. So it totally depends upon what the lessee is expecting to do. Option is given to the lessee. The lessee may exercise that option, may not exercise. So totally depends upon the likelihood of extension or unlikeliness. In my example, because I have been assuming the lessee is likely to extend, so this period has been included in the basic period of 5 to say me the contract life is 8 years. Okay, now I can make another case of the same kind where I'm going to bring a termination. A Limited takes an asset on a lease. Lease agreement allows A Limited to terminate the lease instead of extension, terminate the lease term or lease term after 2 years. After 2 years. So in this case, once again, I will write the 5 years. These 5 years are the ones out of which the first 3 years, first 2 years are non-cancelable. Can I say the first 2 years to be are non-cancelable? Non-cancelable. Non-cancelable. The first 2 periods are non-cancelable. Means in the first 2 years, the lease cannot be cancelled. The first 2 years are the ones in which the lease is not cancelled. Because the lease agreement allows A Limited to terminate the lease after 2 years. So in the first 2 years, it's not cancelable. The first 2 years in which the lease cannot be terminated. In fact, I can say the basic life of this contract is 2 years. But the extra 3 years in it are the ones in which they have an option to terminate. 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 And I can assume over here the option to terminate is unlikely or likely to terminate. Likely to terminate. Now, with that option to terminate is likely to exercise. With the option to terminate is likely to exercise. With the option to terminate is likely to exercise. This will not be included because they wish to exit the contract after 2 years. So what's useful to them is a 2-year life. So for this 3 years to include into those 2 years, the chance of termination is not likely to be there. It means if the chance of termination is not likely to be there, they wish to use that asset for the full 5 years. That's useful to them. That's what I write it up there. For option to terminate, the chance of termination should not likely to be there. Should not likely to be there. This is where you have to put a little bit of weight before we get into the accounting part, how to record the lease, debit, credit, computation and all. You should be knowing it the way the lease term one has to work. Basic period plus option to extend plus option to terminate. The chance of extension is likely to be there. The chance of termination not likely to be there to include it. If the chance of termination is likely to be there, then obviously that option to terminate period will not be included. But if the chance of termination is not likely to be there, it means they do not wish to terminate and use the asset for the whole of its life. 2 examples I have been able to put forward, trying to explain to all of us the way in which situation the lease term will be worked. I hope you are okay with the way the lease term one has to determine. Not the questions will commonly require you to calculate this term of the lease, but somewhere the knowledge that I am giving it to you will be used. And you're preparing it with me. Okay, let's get into the main business thing of the topic, accounting for leasing. What do you see me writing it over? Lessee, as I told you, only the lessee's perspective is examined in FR, not the lessor. So even if I don't write, it's obvious this is the perspective of lessee we are going to talk about. Simplified accounting, single lease accounting. Why 2 types of accounting? Because this one is an option. One can use, one cannot use. This one by default applicable. By default, to every question, this will be applicable. This will be applicable by default. While simplified accounting is an option. Single lease accounting model is an actual topic. This is where we have to invest time, but simplified accounting can take 30 minutes of the course of today. We will finish it and we'll move into the single lease accounting afterwards. Simplified accounting, as the name suggests, is the simplest way of recording the lease. But when we are eligible to use this, it's important. It's not that this is an option that you can use it at any time. In certain scenarios, this option can be exercised, and how to and when to, I can explain that to you all on the next page. But at least this is an option that one can think of using or may not, but this one is by default applicable to almost every contract of lease. Let's go to take simplified accounting on to the next. So what is simplified accounting? Such a nice way I have been able to write it, when that can be used and how can that be used. So when that can be used. Simplified accounting can be used in 2 situations. Short lease and low value asset. Short lease and low value asset. What makes a lease to say short? The term of which is 12 months or less. What makes the lease to be a short? The term of which is 12 months or less. Any lease, the life of which is 12 months or less is said to be a short. or the value of the asset has to be a low value one. What makes the asset to say a low value? Everything is so written that I don't have to write it, or I don't have to do any work onto that. Just a nice way it's being there. And that's what I'm telling you, that the same handout will act like a summary to you and will act like a main explanation document for you, that later when I'll make it available to you, you will be having all the stuff onto it. Like the explanation of lease term was not there the way I was trying to put this example within the same file. So a lot of things I will expect to work onto the same file, where many of the stuff has already been written there onto it. Will be the one same document to have all the explanations, workings, summaries within. Okay, we were concentrating it on when we can use. In these two situations, we can use. First situation, when the lease is a short one. Second situation, when the asset is a low value one. What makes an asset to say a low value? The value of which is 5,000 US dollars or less. The value of which is 5,000 US dollar or less. What makes an asset to say low value? The value of which US dollar 5,000 or less. And value, I'm not talking about the fair value. I'm talking about when it was acquired. The price that was being paid was less than to $5,000 or equal to. Currency is US. That can be translated or converted into any respective currency to say that, okay, in rupees, the low value asset is going to be this value. US dollar 5,000 is the guidance the standard has provided to all of us. An asset is said to be as low value, the value of which is 5,000 US dollars or less when it was acquired, when it was new, when it was constructed, when it was acquired, when it was purchased, the price that was being paid was less than to $5,000 or less. It's not the depreciated value I'm talking about. We're not talking about the revalued amount. I'm talking about the price, the one that was being paid when this asset was acquired. So it's a small value, US $5,000. As far as the assets, investments are concerned, 5,000 US dollars is a small value. In these days, even the cell phones that you buy, an example of an iPhone that you buy, the flagship phone, the high-end phone, I mean, roughly for about $1,500-$1,600. The laptops nowadays that you buy, the high-end laptops, the systems, the workstations that you buy. So it's not as big in contrast to assets, because the assets, they have a bigger values. Suppose if you buy a building, the value of the building will be in millions. If you buy even a plant, the value of that will be in millions. If not in billion, at least will be as close to million. Thousands of the dollars you invest into the purchase of plant and machinery. So in comparison to the purchase of asset, it's a small money. $5,000 is not a big money. For an individual, $5,000 will be a bigger money, but not for a company who has to invest into the purchase of property, plant and equipment. To them, $5,000 is a small amount. So an asset is said to be a small, the value of which is 5,000 US dollars or less. Or the lease has to be a short one. Other than this, the simplified accounting cannot be applied. In these two situations, either of the two situations, I'm not saying that both of the situations have to be there, either of them, may the lease term is short, may the value of asset is low. In either of these two situations, the simplified accounting will be applied. No, I'm not saying must be applied. I'm saying if they wish to apply simplified accounting, then these are the two situations in which they can opt for. But they still do not want to opt. They're not required to. This is not essential. This is not must. Think that, okay, if you are having a short lease or if your asset is a low value one, then you have to must use this simplified accounting. I never have said it. What I said it, that if they have to use the simplified accounting, they can use it out in either of the two situations by opting. Even if they do not wish to opt, they go by using the single lease accounting model, which is by default applicable. How to apply? In profit and loss, the rentals are expensed. As simple as that. Just the way you expense any expense, repair expense, insurance expense, salary expense, pension expense, any expense, the way you record, the same way it will even be recognized. Expensed. The same way it will be expensed. And in statement of financial position, we could have a chance of getting an accrued expense or prepaid expense. Accrued or prepaid, we could have a chance of getting it. Are you listening? Accrued or prepaid expense. Now, accrual is a case where the amount that they have paid slightly less than to what they should have paid. Prepayment is a case where the amount that they have paid is more than to what they should have paid. Means accrual is the scenario where they have paid less. Cost, whatever has been incurred, they have paid less, or they have not even paid, unpaid. It results into what? Payable. Payable is what? Accrued expense. Prepayment is a case where they have paid more to what they have actually incurred in advance. So correspondingly, the statement of financial position, it might result into an accrual or prepayment with a mismatch of payment to what the cost has been incurred. And if whatever the cost that they have incurred, if the same has been paid, neither the accrual nor the prepayment will arise. Neither the accrual nor the prepayment will arise. But if it does not match, what did they pay does not match with what has been expensed, results into what? Either an accrued or prepaid expense. So that's how the way the simplified accounting one has to perform. We have two questions on which I can revise this calculation stuff, but we're ended up with. First thing that you need to know, okay, when I can use. Second thing, how can I use? When I can use, the lease has to be a short one, or the value of the asset has to be a low one. Short lease is the one, the life of which is 12 months or less. Value of the asset has to be a low one, the value of which is US $5,000 less. In these two situations, I can think of applying the simplify. How? Keep on expensing the rentals out in the profit and loss. While the correspondingly, you might end up getting an accrued expense, prepaid expense, totally depends upon the mismatch of payment. So on which part of your lecture notes the explanation has been done? Yeah, 8.6. Exactly the same they have explained, that there are two situations in which one can think of applying, where the asset has to be a low value one and lease has to be a short one. 12 months or less is a short lease. $5,000 or less is a low value. Accounting treatment, have to recognize the lease payments on a straight line basis in profit and loss. So lease payments are in fact what? The rentals. That's how the way the things are written back into your lecture notes, which I have been able to make the summary of that, makes the whole task a lot easier to understand. Followed by some questions we can practice. Illustrative example 8.5, the first one we can do. Skipton leases a car for 1 year. Now that 1 year thing is what? A short lease. The 1 year is what? A short lease. Paying $500 per month in 8 years. A deposit of 600 is payable at the start of lease term. A deposit of 600 is payable at the start of the lease. How is this report in Skipton's financial statements for the year ended 31st of December, 9 and December 10? The first thing first, I have to see the day the contract was signed. The day, the grant date is 1st of September. This is the grant date. Grant date is the date when the lease commences, when the lease starts, initiates, incepts. Inception date, grant date the same. Simply contract signing date is the date of grant. 1st of September 2009. The day the contract was signed, the contract life is 12 months. The lease term is for 12 months. The rentals are 500 per month, and there is a deposit of 600. The year that I'm into ends on 31st of December 9. It starts on 1st of Jan 2009. If it ends on December 9, starts on 1st of Jan 9. Ends on December 9, starts on 1st of Jan 9. How many months are involved in? We can see September, October, November, December. We can see there are 4 months in it. So when I will try to expense the rentals off, I will be considering these 4 months. Very important for us to analyze these things. First of all, can I use a simplified accounting over to it? Yes, I can. What makes me to say that simplified accounting can be used? The lease term is short. Is it short or not? It means I can use a simplified accounting. Let's go to use. How to? I need to find the rental expense, the one that I have to expense it out on a straight line basis. $500 plus month plus deposit divided by 12. What is the straight line answer that I have been able to get? 550 per month. Is it? Yeah. If the deposit was not there, it would have been 500, but because of deposit, the answer has turned out to be 550 each month. This is the amount that I should go to expense it up to each month of the lease for the next 12 months. This is the total cost of rent to me. 12 months of rent plus deposit divided by 12. And this is the cost that I incur for each month, which I will go to expense. This is how the way one has to find the straight line rental expense. I'm telling you, if the question did not have a deposit in, then whatever the rent itself will be the figure of expense. But because of that deposit, this also needs to be spread out over the life of 12. So I came to divide this by 12 to get me what? 50 each month over and above to 500. This is decided to be the figure I have to expense to each year's profit and loss. Just give me 1 minute. Let's go and do the accounting of it by getting into the first year. I'll go and prepare the T account of tax for the rental. So this is the rent account that I have been able to prepare for the year that I'm into right now, that ends on December 9. What I have to debit, what I have to credit. Let's first of all get into the payments. How many payments we have made into this year? The contract was signed on this date and the payments are happening in 8 years. Yes. So September, areas means by the time the month will end, we will pay. September 30th, the first payment. October 31st, the second payment. November 30th, the third payment. And 31st of December is going to be the day the fourth 500 will be paid. So with this, each time the payment is made, the rent account takes the debit of that payment, bank account takes the credit of it. Rent account takes the debit of that payment, bank account takes the credit. Let's not forget, they also have paid a deposit over and above to it. There are 4 payments of 500 based on to which I have been able to debit the rent account, credit the bank. And this has been the payment of one-off deposit. The payments of rentals. And this is the payment of deposit. What we have decided to expense to each month, 550. So 550 into 4 times, the figure will be what? 550 into 4 times, the figure will be what? 2200. So with this, I should have to credit the rental account and debit what? Profit and loss. So this is the amount that's been taken into profit and loss. This is the amount that's what we have taken into profit and loss. Rent account, credit, debit, the profit and loss. A credit of rent account, a debit of, so what has been taken into profit and loss is 2200. The same expense that we have decided to expense to each month of the lease, 550, I had been able to taken it into profit and loss. And this is where now you can see the difference of 400 onto both the sides, and that falls onto this, suggests to all of us what? A prepayment or not? This is the amount of rental we should have paid only by now, but that's what we have paid. 400 extra. That payment will now be called as prepaid expense. Prepaid expense acts like a balance of asset, current asset. That's the accounting of first year. Now I'm getting into the next year to try and show to you what's going to happen the next time around into the rent account. The closing of class is going to become an opening for next year. The closing of class is becoming an opening for the next year, as you all can see. Same thing is going to happen. If I have paid 4 payments the last time, I will go to pay 8 payments into this year. So rent account debit, bank account credit with 4,000. A debit of rent account, the credit of bank. This is not the time that they will pay deposit. What we have decided to expense into each month, 550 for 8 times, the figure will turn out to be what? 4,400 or not. So with that, the rent expense account will be credited, the profit and loss will be debited. And this in the end will result into what? A closure, a cancellation. That's how the way the accounting of the simplified accounting has to go by. What we have been left out onto that side automatically turns out to be the answer which we are expensing it out. This is being done for the year 2009. This is being done for the year 2008, 10. This has been done for 2009. This has been done for 2008. And that's what you also can see into the solution. First of all, they did work this 550. The prepayment of 400, they have found it to be an asset balance into that year, which in the next year has been cancelled off. The solution has been produced in the way that I'm not preparing it. I'm rather preparing it into a T account. But obviously in the T account, what I have done is the double entry. You can observe the same has been done in the first year's double entry. What has been expensed to profit and loss is 2200. That's what I also have taken into profit and loss. Resulted into a prepayment of 4. This is what I also have resulted into. While payment was 2600. So don't you see me recording the payment with 2600? Second year. A second year is a year of expensing the lease to profit and loss 4400. That's what I have been able to expense. Payment was 4000. See, payment was 4000, the same that I have written it. And prepayment is cancelled. The one that they had it in the start has been cancelled. Pretty much the same. Learning example 8.6 requires us to answer what? Woodhouse leases the 10 laptop computers for 3-year lease. The laptops are provided now and each is having a fair value of $600 at the inception of the lease. Can the Woodhouse apply the simplified accounting to lease? Can they apply simplified accounting? 10 laptops leased for 36 months. Each laptop is having a value of $600. So if I look into the term of the lease, this looks to me more than 212. And it's not a short lease. My first conclusion is it's not a short lease. So when it's not a short lease, we cannot apply simplified accounting. But yes, if the value of the asset I have found out to be less than to that 5,000 mark, based on which I can call it to be as low value asset. And when this has become low value asset, my answer is yes, the simplified accounting can now be used. This is what this question wants us to answer. (8.7) requires us to do one more effort before we go into single lease accounting model, very next to it. So what's happening into learning example 8.5.7. On August 7th, Ashley leases a truck with a fair value of 80,000 on a 36 months lease. Which date? 1st of August 7. 1st of August 7. This is the date of grant. Standing it onto that date, leases the truck with a fair value of 80,000. So truck leased for 36 months. The value of truck is 80,000 when it was acquired. Now, if I come to apply the same conditions, the way I was applying that to the previous question, does not look to me like a short lease since it's more than 12 months. And even the value of the asset does not seem to me a low one since more than 5,000. It is supposed to be more than because it's a truck. And you cannot expect to have a truck for a value of $5,000 or less. Definitely it will be in thousands, 5-digit figure. So apparently simplified accounting cannot be used because the asset is not low value one. The lease is not the short one. So we cannot apply simplified accounting. But that's just the first line we have read. Let's continue reading. Lease payments are this much per month payable in advance. As incentive to the first month's rental was provided by the lessor rent-free. What is it? First month rental was provided rent-free. What does that mean? It means that the lessee does not have to pay first month rent, but will use it. It's incentive that if the contract life is 36 months, in other words, I can say the lessee only has to pay 35 rents, not 36. Although we'll use the truck for 36 months, we'll pay 35 rents because the first rent is exempted. The lease has a break clause allowing the Ashley to terminate the agreement early after 12 months without penalty. Oh, so we have talked about this thing before. Remember, option to terminate the contract. Lease has a clause allowing the Ashville to terminate the agreement after 12 months. Point to notice, termination is there. After 12 months, they can exercise this. And the belief of the management is that they will terminate the contract after 12 months. That's what the management of Ashville is believing. Means that's what they are thinking of doing. That's what they are likely to do. That's what are thinking to do. So from this piece of information, I got that out of 36 months, 12 months are non-cancelable. And 24 months are option to terminate period. Option to terminate period. And they are likely to terminate. They are likely to terminate. So if they are likely to terminate, it means they will be wishing to use that truck only for 12 next months, not to the extra 24. Therefore, when I should not include it, the term of the contract has been finalized it to be about what now? 12 months or not? So when that has become a life of a contract, makes me to say it is a short lease. Check the importance of that one little explanation. I've had it in the start, because it has now changed the whole dynamics of this question. Initially, I thought the simplified accounting cannot be used because it's not a short lease. It's not a low value asset. But then when I came to read the entire question, they suggested, look, after 12 months, Ashville can terminate out of contract, which the Ashville management, they are believing to do. So if I do not include that option to terminate that period, the contract is left up to be only for 12 months, which is a lease term, which is a short lease. Now it means what? I cannot apply simplified accounting, which is what I can come down to apply. Okay. Everything contributes. May it be a little explanation, may it be a bigger explanation. When you do it, everything matters. Everything counts. If you don't pay attention to this definition of lease term, because you may be thinking of that it's something that the lecturer was just explaining, I should rather concentrate more onto accounting part and all, then check the importance of that explanation. That how have I been able to make the use of it, which later have become the decisive factor to say me to apply simplified accounting or not, that have become a decisive factor. And if I do not know, I will be always like, look, this is not a short lease. It's a 36 months contract. So let me not go and apply simplified accounting because that's not a short lease. But I have proved it to all of you why the simplified accounting we are going to apply, because the life of the contract has been revised to only 12 months. How come? In the first 12 months, it cannot be cancelled. After, it can be cancelled, and they are expecting to cancel. So better not to include that period. Include only the one that they wish to use that truck for. That's for 12 months only. That's the lease term, and that's a short lease. Simplified accounting, surely applicable. How to apply? You've seen that way. Rentals to expense. So the rental cost is $1,500 a month. Once again, I'm going to find that rental expense on a straight line basis. $1,500 multiplied by 12 times. The life of the lease is 12, but one has to be a little careful. They had remembered an incentive which allows them to pay not the first month rent. So effectively, they will pay 11 rents. Out of 12 months of the life, they will pay 11 months. Since the first month rental is provided free. So what will be the expense that they should have to go and make it into each year's profit loss? That's going to be 1,350. 1375, in fact, 1375. 1375. I can prepare the rental account to end up this whole story for one last time. Let's go to debit the rent account with the payments. Are they making the payments in advance or arrears? They're making the payments in advance, which means the very first payment they will pay itself the day the contract is signed. Which day is the day the contract is signed? 1st of August. And all the way down to December, how many months we have? August, September, October, November, December. So there'll be 5 payments: August, September, October, November, December. But no, first month is a month of no rent payment. So the first payment will be made rather on 1st of September. 1st of August, no payment. 1st September will be the first month of payment. 1st October, 1st November, 1st December, 4 payments of 1500. So rent expense account debit, bank of rentals. What did I decide to expense is 1375. So let's go to expense. How many months I should go to expense? Now, months to expense does not depend upon payment was made, not made. That totally depends upon the day the contract is signed and how many months we have to run. August, September, October, November, December. We have 5 months to run. So I need to expense 5 months of rent there. So 1375 for 5 times is what? 1375 for 5 times is 6875. 6875. So rent, expense account credit, profit loss debit. That's being taken into profit loss. Looks to me this time we are having a bit of accrual, since this is the amount of rental that they should have paid, but they only have paid 6,000. So what they have paid less turns out to be a balance of accrued expense, which will act like a balance of current liability. See, one question has taken the prepayment, this has taken the liability, accrued expense. So see, 45 minutes I've spent literally on something which is not really a worry, because the worry is yet to start. Single lease accounting model is yet to start. This is not a worry, but still a topic when you have to learn it by all of its aspects in a good manner. Time is required. Time is definitely required over anything. To have a quick recap, let's go and take ourselves back to the start of this method, simplified accounting. When can we use? When we have short lease or when we have a low value asset. What makes the lease to say short? 12 months or less. What makes the asset to say low value? $5,000 or less. How to apply? Expense the rentals out. Correspondingly, we might result into a prepayment accrual depending upon the payment does not match with the expense, which exactly I came down to show to all of you in illustrated example 8.5. Let me not get into the revision of computation because this will again waste 5-10 minutes. You always have got the liberty to watch the recordings of whatever I do, which I always insist you to go and make the benefit out of it. And if you don't make the benefit out of that, then later you will find it so difficult when all the videos from the course will be pulled up in one folder and you'll be like, which video should I open to watch what? It's a situation that you will be in if not on a regular basis, you will access those resources to take the help from. Later, you will just be like, I'm not getting into that. It's too much. 25 recordings I have to watch. Each recording is for 3 hours. How can I watch all of them? Do I have that much time? You will not. If you cannot develop an interest in watching it up, in that week itself, where you have 7 days or 6 days to review it, later, forget about it. You will not do it. I can challenge you on that. You can prove me wrong. If not in that week, you can review, or you cannot gain a courage to spend a bit of time out of your life and watching it. Later, forget about it. In the month of May, you will be able to access the whole folder and watch it. And then even you watch it out, you will not find the time to work at your own side. And on the day of exam, you will be sitting wondering what to do, because never in the life you have practiced anything. You rather had been feeling happy about watching the videos. And then when the time will come to work the same stuff, your hands will not work, because you never have given your hands a work to work the stuff. So please act the way I want you to from the very first day. I'm requesting you, develop some good habits. If you have come into the course, not just for the sake of learning the reporting standards, also the guidelines that I shared to you, you have to respect me for that. All in the benefits of yours. There are a lot of board works that you can plan to organize it. You can download them, you can print them and make the one file, which you always can keep the hard copy of it to access it. You'll be happy to see it's my lecturer's handwriting that I have got all at my side. That's a privilege for me. That's an honor for me. In a well-maintained document, whatever he was doing it right, he was perfectly writing it, and it's perfect thing that I could get. I have to study it from. And then on side of that, you keep the hard copy of board work with you onto your table and play the video. The same stuff will go on video, and you have this into your handwork and you are watching it, working it out. You can't pass this paper this way. You can't pass it by any other way this way. Believe me, if the life of yours have become so simpler by this way of arrangement, it does not make you passing your exam. Nothing in the world can make you pass this exam otherwise. So now we are getting into the second method, which in fact, if you ask me, is a main method to start our explanation on single lease accounting model, when this has to be used, how this has to be used, the double entries, the computations, all coming to your way. Let's start off with single lease accounting. Alongside, I have been trying to show to all of you since the first day, the things are written back into your detailed lecture notes. Everything that I have been able to bring it to you, I am trying to show to you of that these are the things yet you have to invest the time. What I've told you in start, study texts are not required. Did I ever open the study text in the classes? Did I ever have said something to you something and go and do something from your study text? Did I ever? Because in the first course, I made it clear that study text I'm not going to use. I have given to you because I have promised to give it to you, but I'm not going to use it since I'll be focusing on lecture notes, my board explanations, the summaries, the revision kit, and that's what we are focusing on each time. One side I have a summary open, then we have revision kit open, board work open, detailed lecture notes are open. So everywhere when we do things, I come to highlight and show to all of you, look, this is how the way things are written back into your lecture notes, onto your summaries. These are 4 to 5 objective test questions we have, which I have practiced. See, do you see anything written over here that I have not talked about? Over here, this example, these two learning examples. What's starting next to it? It's something else. Simplified accounting is completed from the topic of IFRS 16. Cannot spend further time over to it. And that shows also the importance of simplified accounting. If this chapter, suppose, have got 50 odd pages, just about this page, simplified accounting has been explained, followed by some questions. Effectively 2 pages out from the entire chapter we have designated to simplified accounting. So the rest of chapter is focusing on what? Focusing on what? The rest of the chapter, single lease accounting, which is a main thing. Let's get into it. Single lease accounting. Such a nice manner. I have been able to write this whole accounting by doing my best to make it easier for you. The same summary, normally you used to get it into a printed form, into a file form, PDF form, but you can today see this into the handwritten notes, which I'm telling you is going to be a lot of a benefit when at the end of the day, you will get the copy of that and you'll be feeling it like every word of that has been written by my tutor itself. And you will be assuming that everything that's been written should have to be the absolute right thing, because it's not me writing this whole, it's my lecturer who has created, constructed for me. So what is single lease accounting? First of all, why the word single is used? Why the word single is used? What's the whole significance of this word over here? Single. Single means one. One. What's the significance of single word over here? Simplified, we do understand because the accounting was simple. There was nothing except we have to expense the rentals out. End of a story. So it was called as simple accounting. Why the word single is used? The background is there was a previous standard on lease, IS 17, which is no longer there because IFRS 16 has superseded. The IFRS 16, the one that we are talking about, is a new standard on lease. Previous one was IS 17. So according to IS 17, the lease was always classified in two types: operating lease and finance lease. So this explanation is not important as far as your course preparation is concerned, but just for information, I'm telling you. In the previous standard, leases were classified in two types: operating and finance. When the new standard has been launched 2-3 years ago, have become the part of our syllabus also 2-3 years ago, the classification is removed. So we call it as single lease model, as we have single classification. We do not call the lease to be in two types. We call the lease to be that single contract. We don't call it that this is operating lease, this is finance lease. We just call the contract to be that one single thing. No more classification. So that's the word single we have used. That's the significance of it. So leases are used to be classified into operating. You still do actually in your management accounting courses, in financial management courses, if you have been taking financial management course, or you have taken it in recent exam setting, or you will take it in next exam setting, financial management course. So where you will come to study operating finance. Because financial reporting is regulated. So what is there in the standards? According to that, we perform the accounting. So if the standard has removed the classification of operating leases into two types, we will have to listen to. And we will be like, okay, the contract only is of one type. So we call it as single lease accounting. But when you will apply the same into your financial management courses, management accounting courses, you still can classify them in two parts. So there you will not be like, okay, the lecturer was saying in the topic of financial reporting, the leases are no longer classified into two. So what's happening now today? I see operating finance. Because financing and operating leases, these are the two types you will still be studying in management accounting, financial management courses, not in financial reporting courses anymore. It's as if when you perform the inventory valuation, you have an option to calculate the cost by using last in first out method, first in first out method, average AFCO method, 3 methods. So for management accounting, you apply all 3. All are applicable depending upon what the management has a policy to choose. So depends on the policy. So management makes their own policy and they follow it. There's no standard onto it. Management of this company may have the policy of using this method. The management of another company may have a policy of using that method. So it depends upon the policy the management has to go by using AFCO method, last in first out method first. But when you talk about finding the value of an inventory for your financial statements, which standard do you follow? IAS 2. And according to IAS 2, which two of the methods are permitted? First in, first out and AFCO. There you don't use the LIFO method. So you can't say that the last in, first out method does not exist. It does exist, but as far as the financial reporting standards are concerned, it cannot be used. It can be used for management accounting, but cannot be used for financial reporting standards. Okay, it's same way, the leases can still be classified into operating finance for management purpose, internal purpose, but when they have to report the financials on the financial statement, cannot be classified this into finance and operating. We just follow a single lease contract. I hope you have been able to get, you have been able to understand the importance of this word single before I start off really with the explanation of what this model is all about. Let's get into it. So being a lessee, what is the first thing that I should have to do on the date of grant standing? Two things I will be required to do. First thing, I will be required to recognize the leased asset and lease liability. I'm a lessee. I'll be required to record the two things, asset on one side, liability on the other side. Asset debit, liability credit. A debit of asset account, a credit of liability. But what is this term, right of use asset? It's a term that you might find it difficult to digest. Right of use asset. So this is a formal terminology. We have to remember it for the leased asset. Same way, lease liability is a formal terminology. You have to use it for the lease. See, even if you go a little slow on right of use, remember in the start of this topic today, I was trying to explain to all of you the definition of contract. What was happening? APLC was giving the BPLC a right of using an asset. Right of using an asset means was granting a permission to use, allowing to use an asset. So if you go a little slowly onto term, that right of use asset, that BPLC has been given a right to use it by the lessor. The BPLC does not own it, rather only uses it. So it's called as to BPLC, not an owned asset, rather a right of using. Now you probably have started getting it. Okay, why do I call this to be as a right of use asset? Because it's an asset for which the lessee has been given a right to use it by the lessor. So to lessee, it must have been a right of use asset. That's what I even have written it on to the next few words. Asset for which the lessee has been given a right to use it by the lessor. So it's called as right of use asset. While the obligation of the lessee to lessor is called as lease liability, and that obligation will be of what? Definitely the rentals. Lessee is obliged to pay rentals to lessor over the life. So the obligation of lessee to lessor to pay those rentals is called as lease liability, because the rentals are paid over the life. So whatever the rentals the lessee is supposed to pay in a contract over the next 5 years is the liability of lessee towards lessor. It's called as lease liability. So I've been able to explain to you all crystal clearly the two of the terms. Probably for the very first time in your life have come to your way, right of use asset and lease liability. At what value? The present value of the future lease payments. This is the calculation. I will come to explain how to work present value of future lease payments. In the past, recently, I have explained to all of you how to calculate the present value. Remember the calculation of value in use for impairment topic. There I was trying to discount the cash flows over the life. So you know that technique. You will see me doing that calculation one more time today. This time, the cash flows that I will be discounting are in fact going to be the rentals over the life, factor of discount, and present value. Asset debit, liability credit, as simple as that. Right of use asset account debit is liability credit. So if you only focus on these two words, asset debit, liability credit, just the titles we have been able to assign it to. It's a right of use asset, it's the lease liability, but in reality, on the one side, you are debiting an asset account, on the other side, correspondingly, you have been crediting the liability. This liability will act like a balance of loan now, as if you have taken an asset on a loan. You borrow money from an end, and using that money to acquire an asset with. So asset debit, loan credit. This is literally we are thinking of. Your asset is financed. Normally, when you borrow a money, what happens? Bank debit, loan credit. But this time, rather you borrow a money, you rather have taken an asset on a lease. So you debit the asset account instead of debit the bank. Loan has to credit because it's a credit balance. That's the first thing, being the lessee, I have to do. At what amount we are going to record these two figures, present value of the lease payment. So this is the calculation I will come to explain to all of you how to find it. It's a simple, repetitive computation. If you had been there in the last course, and if you had seen me working the value in use, same way I will adapt in finding this amount. Cash flow column, discount factor column, and present value column. And the total of present value will be the value at which the step one will be recognized. Cash flows this time will be the cash flows of rentals. This is what I will go to discount over the life, rental payments. Okay. Next step. Now, because I have been able to record an asset, I will think of working the depreciation over to it. Depreciate the right of use asset depending upon two possibilities. Ownership does transfer to lessee at the end of the lease term and does not transfer to lessee at the end of the lease term. See, such a nice way everything has been explained by making the possibilities that ownership does pass on to the lessee at the end of the lease term, the ownership does not pass on to. If the ownership passes on to the lessee at the end of the lease term, what should we do? We will take the useful life to depreciate. If the ownership in case does not pass on, we have to take the shorter of two things, whichever is shorter. In such a nice way, this summary handout has been prepared for you. When you read it out, you don't find it difficult or you don't feel lost about, do not know what to do in which situation. So if the ownership passes on to the lessee at the end of the lease term, we must have to use the useful life to depreciate. And when an ownership does not pass on to the lessee at the end of the lease term, we must have to take the shorter of two things, the useful life and the lease term. Depreciation expense one has to debit. Right of use asset account one has to credit. And that's the normal double entry for the depreciation. We debit the expense into profit and loss for the depreciation, and asset correspondingly is credited. Okay, after explaining what normally happens into your questions, the useful life, the lease term will be given, which will be the one to use to depreciate. Because the question usually does not even tell us about the useful life, because it is assumed to be the same as lease term in our questions. So the question normally tells us about the lease term, which is what we will use to depreciate. But I'm not saying it that it's the only thing that's going to happen. I'm saying it usually the question provides us only with the lease term, which is what we will use to depreciate. But when the question provides us with a useful life, you then have to be a little worried of using which one. So there you have to see, okay, the ownership is passing on to the lessee, not passing on. So which case will become exercisable. Knowledge, I have been able to give it to you. To use this knowledge or not, depending upon the requirement of the question. Okay, that is the second step. No confusion. Such a straight way, easy manner. It's being written with no confusion. Passing on useful life, passing on the ownership to an asset, useful life has to be used. Not passing it on, take the shorter of two, useful life and the lease term. Debit the depreciation expense account, credit what? The asset. Third step. Now, third step is about calculating the finance cost on the loan. Remember the liability, I was treating it like a balance of loan. So in third step, now I need to calculate the finance cost onto this loan. So finance cost will be worked based on the outstanding liability at each year end. Very important. Each year, the liability will change, because every time when you go and make a payment of rental, the balance of the liability will diminish. will reduce. So that year's finance cost will be based upon the updated balance of liability. Is it? And quite logical or not, if I borrow a money and if I have been starting repaying the part, so whatever the money that I owed currently, I am supposed to pay a finance cost onto that, not the total amount that I borrowed 2 years ago, because plenty of the borrowed money has been returned. So what do I now owe? That will be used to calculate the finance cost for each period. This is the whole logic. So finance cost with that has to debit, lease liability has to credit. Debit the finance cost is like a normal thing. As you're debiting the depreciation, so it's a cost, one has to debit the same into profit and loss. Credit the loan account. And finally, the payment, which could either be in advance or arrears. With the payment, the liability has to debit, the bank has to credit. So these 4 steps, you have to at least go over to it with me. You have. Now we have got 2 questions coming to our way on which I will apply these 4 steps. One question will cover the area side, the other will cover the advanced side. I will go to apply these 4 steps, exactly these 4 steps, by taking those 2 questions, which will enable you to even revise this model, which I don't have to revise. Naturally, you'll be able to revise this model when I will go to apply the knowledge onto 2 questions coming to our way. Something is there to learn. You cannot call this method to be a simplified accounting, because simplified accounting was just about expensing the rentals out. It has got something to do asset recognized, depreciating, loan recognized, calculating the finance cost. It looks to all of us, yeah, it has got something to invest time. And we are. Which question we are going to take it first? It's going to be learning example 8.3. Calculate the lease liability in each of the reporting date over the 4-year lease term. So G entered into a 4-year finance lease on 1st of Jan 2008. So this is the lease term as they have told us about. And this is set to be as the day of the grant. The lease requires to have 4 annual payments in arrears. Payments are happening in arrears. The interest rate that's implicit to lease is 6.5%, giving a present value of the future lease payments of 60,000. Oh, that value is given. Lucky. Okay, to tell you, in most of the questions of your lease, the present value of the future lease payments will be given to you. The present value of the future lease payments will be given to you in most of the situations. But in rare situations, you can be asked to calculate. Like in this case, it's given. But in the next question we will do after to it, it won't be given. So there I'll come to explain to you. Right now, I can just pick that amount to at least apply the 4 steps with this. At least we can apply 4 steps with this. Learning example 8.3. G entered into a 4-year lease on agreement on 1st of January, and the day of grant is the day when I will come to record this old double entry. I will have to debit the right of use asset account and credit what? The lease liability. Right of use asset account debit, lease liability account credit with the value which is given to us as 60,000. A debit of right of use asset and a credit of lease. That's what we have done, standing it onto the date of grant. Well, the rest of the stuff must have to be done standing it on the date of reporting, because you cannot expect to calculate the depreciation standing it on the date of grant itself. So I'll have to go and end that year and work the finance cost, work the depreciation, and also the payment. All will happen on December 31st. The first thing that's going to happen on December 31st is the calculation of depreciation. What do we have to debit? What do we have to credit? The depreciation expense account has to debit, and the right of use asset account credit by the amount the life is given as 4. The figure is 15,000 per annum. This is what I told you, that in most of the situations, the term of the contract would only be mentioned. The life of the lease is mentioned, but not you are being provided with the life of the asset. So the only one option that I can go by is by using the life of the lease term to depreciate, which is 4 years. Once the answer is worked, I will go to recognize the depreciation expense account debit, the right of use asset account credit. Okay. Then comes the finance cost. Okay. I'm going to prepare a table of lease for the very first time. It will have 5 columns to prepare in, with the opening balance to be the first one, interest expense to be the next one, closing balance, payments of rentals, and final closing balance. 5 columns I have been able to prepare. Opening balance, interest expense, closing, rentals, and closing. Without preparing a table of lease, impossible for all of us to work the answers, even for me. To some extent, I can work, but in the complex situation, the need of preparing the table is essential there, important there. So you just have to sit there and see the way I'm going to decorate, what has to come into each column. If you know one year, then you can do the same for second, third, fourth year. The first year ends on 31st of December 2008. There will definitely be 4 rows depending upon the life of the contract. 8, 9, 10, 11. 8, 9, 10, 11. 8, 9, 10, 11. The opening balance is 60,000. This balance we have taken it from where? This balance we have taken it from here. See, this is the value at which the right of use asset was initially recognized and lease liability. So I did use 60,000 to depreciate. Now I will go and use that 60,000 to write it being the part of the table of lease. So what gets into a table of lease? What we have recorded into step number 1. Interest expense, that's implicit to lease is 6.5. Well, the rentals are 17500. 3.5% multiplied by 60,000, the figure is 2,100. Is it 6.5%? Yeah, that's the one that's implicit to the lease. The implicit rate in the lease is 6.5%. The payments are happening in advance. So 6.5 multiplied by 60,000, the figure has turned out to be 3,900. It will become 63900. Subtracting the figure of 1700 from the figure turns out to be 46400. The closing of last becoming the opening of next year gives us the figure of 316. This is 49416. 17500. 31916. 2075. That's about 33991. 17500. The figure is 16491. This is 1072. 1072 plus 16491, 17563 is what I have found. Now, if you look into that watchfully, I have been able to prepare the table of lease. What I have done for first row, I have done the same for second, third, and fourth. The payments of rentals are throughout the same as the contractual payment. While the finance cost, you can see me working it out each year based onto the outstanding balance. This is what I was stating, that you have to calculate the finance cost based on to the outstanding balance into each period. So the way each time the liability is diminishing, the finance cost is also diminishing, since you're working it out based onto it. The finance cost remains to be the same while the figure changes, because each year I have been working it out based on to the outstanding balance. Noticeably, in the very last row, whatever the answer has turned out to be, it's so close to the one the last payment will pay. What is the answer that we have got? 63. What is the answer that we have got? The rounding off problem, which will be there. You do not need to be worried on. You will see the balancing figure of $100, $200, $300 will be there. This answer has to be close to each. It will be fine. The rounding off problem, if you find it, it's going to be the part of the questions of the lease, I'm telling you. You only have to see in the last year how much close the figure has turned out to be, which in the last rental, when I will pay, the contract will finish. The contract will end. This is going to be the cost of finance for each of the year. And any of the year's finance cost can be asked to answer in objective test question. Second year's finance cost, then you will go to choose this and select the option A, B, C, D. This is the finance cost of first year. This is going to be the balance of total liability. This is going to be the balance of liability. But if I have to split this liability into two parts, current portion of it, non-current portion of it, since the payments are annual, so some portion of the rental payment is current, some portion of that has to be non-current. This needs to be split off in two parts. That is another explanation I can do. So if I am preparing the financial statements for December 2008, my first year of lease, 31st of December 2008, the total liability is 46400. This needs to be split off in two parts, the current portion of it, the non-current portion of it. How to split this off in two parts? See, this is the liability balance that I see at the end of this year. This is the liability balance that I see at the end of next year. So the movement of this year's liability balance to the next year's liability is what we call it as a current liability portion. It's as if you have an opening balance and the closing. So the whole change from the 1 year's balance to the next year's balance that we have found is in fact the change of 12 months within, which is the current portion of it. So to find the current portion, we need to compare the liability at the end of first year with the liability at the end of next year. $46400 minus 31916. The figure has turned out to be 14484. 14484. If this becomes current, the non-current has to be a balancing one. So if the total liability is 46400, this goes to current side, the balancing figure the current will take. It's going to be what? 31916, which in fact is going to be the answer of next row. These are all the explanations that never in the life you have been with you, and you should be feel so much excited about. You should feel so much good about that. My level of knowledge is updated Each time I'm taking the course of FR, my level is updating. Last time I came to understand the whole impairment thing that never in the life I was aware of. A lot of terminologies like recoverable amount, value in use, fair value less cost to sell, cash netting unit. I was never aware of it. But then the whole topic when was explained to me, I had understood, not just the sake of passing the exam, rather being myself as a finance professional, my level is updating. Each time I take a course, I learn new things. Today, you are learning the way the lease liabilities are accounted for in your financial statements. The portion of that goes on to current side, the portion that goes into non-current side, you're clearly working this out, this thing for the very first time. So this has been taken into profit loss as a finance cost. This is the balance of liability. What portion of that is current? What will be the non-current? How did I find the current? By observing the movement, the liability I see at the end of this year compared with the liability at the end of next year. So the whole chain that I have found is in fact the change of 12 months with. Okay with this? No problem. If I have to prepare the extracts of statement of financial position for this year I'm into, December 8. So in the statement of financial position, the two things will come. First of all, the non-current assets. Non-current asset, within which I will come to write the property, plant, and equipment. And then non-current liabilities. Within which we have lease liability, and current liabilities. So what has been the value of property, plant, and equipment? 60,000 is the amount at which it was recognized. And the depreciation was by 15,000. So the net answer that I've got is 45,000. See, this is the value at which the right of use asset was initially recognized. And this is what we have come down to depreciate. The lease liability. The current portion of that is 14484. The non-current portion of that is 31916. If I am preparing the statement of profit and loss for the same year, December 8, two things to go by: the depreciation expense and the finance cost. The depreciation expense is 15,000. The finance cost is 3,900. Your knowledge with regards to financial statements are extending. You never knew before then this, that the lease liabilities are shown in the statement like this. Or the part of that goes into current, the part goes into non-current, and how to split the total into two parts. You never aware of that before. While the property, plant, and equipment will be the same thing as you are recording the normal owned plant, you will record the right of use asset the same way. It has to form the part of property, plant, and equipment head, the same head in which you have recorded the IAS 16 tangible non-current asset. You can use the same head to record the right of use asset within. The way I have. After depreciating, the depreciation goes to profit and loss, and the finance cost is also by taking it from the table of lease. This is the full length explanation of the single lease accounting model with the presentation aspects. I just have not been able to complete my side onto table. I rather also have been able to explain to all of you that what did we get out of that table. The balances of lease liability. the balances of finance cost, and then the lease liability being split off in two of those parts. And in the end, also the presentation, the way I will go to decorate that stuff on the face of the financial statement, which is as important as learning the accounting. The presentation is also important. Okay, the last thing that from this question I have to, I won't say explain, to tell. Suppose if I have been asked to answer for this year, do I need to prepare the whole table of lease? Tell me, do I need to prepare the whole table of lease if they want me to calculate the finance cost of this year, the liability of this year? Do I need to prepare the whole table of lease? I have done it because here I am explaining to all of you A to Z, but you will be wasting a lot of time if the question requires you to calculate the answer of this very year and you're starting to prepare the whole table of lease. So for that reason, I need to see how many rows are there to prepare necessarily. How many rows? Only the two. Because from the first row, we will be able to get the balance of finance cost. We will be able to get the balance of total liability. But when we will come down to split this off into current and non-current, we need to have the liability balance of next year with us. Else you cannot find the current liability for the first year. So decided, in order to answer the 1 year, the two rows are required. The row of that year itself and the row next to it. Third and fourth row, totally a waste of time. Don't do it. In the class, I had to explain that to you, but don't just go to prepare those rows. Those are not being required. And you should know why, because the first two rows I should only have to use to take the figures of the first year, finance cost of first year, liability of first year. But yeah, to split this off into current, non-current part, I need to have the liability at the end of next year with me. Else I won't be able to find the current liability. As you can see, this, how crystal clearly I have been spending time and explaining to all of you that one little small question. The next question coming to our way is of a same kind, but will bring what? Advance payments. The one we have covered in it, areas. I will repeat the same process onto this question by explaining to all of you that what could possibly be a difference you have to see when the payments are happening in advance. But after the break of 10 minutes. Let's continue the same session in about 10 minutes time. Do not go anywhere. I will see you in 10 minutes to resume the session. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. Let's take another question of the same kind, which will rather be covering the advanced rentals. Thornton acquired an asset by the way of finance lease on 1st of July 8. The lease contract required to have 5 payments in advance of 25,000. The interest rate that's implicit into a lease is 11%. Thornton's year end is June 30th. Same requirement, same thing we have to do. Learning example 8.4, if I'm working, we need to start off this with the step number 1. Standing it onto the date of grant, we have to recognize that it's 1st of July 2008. 1st of July 2008. So one has to debit the right of use asset and one has to credit the lease liability. A debit of right of use asset account and a credit of lease liability. Now this time the amounts are not given to us, and that's what I was talking about, that I will explain it to you. We're not being provided with the present value of the future lease payments. We have to rather find it by ourselves. So how to find it? I will go to write 5 cash flows, 1, 2, 3, 4, 5. And there I will be writing those rentals, discount factor, and present value, which is 11%. So the cash flows are 25,000 for all the 5 years. Payments are happening in advance. That means the very first rental I have paid the day the contract is signed. The very first rental I have paid the day the contract is signed. That won't have a discounting effect. See, I sign a contract, I pay 25,000. So what I pay today is already a present value. That payment requires to have no discounting. The discounting will start as from the next cash flow, because this is the one that I expect to pay at the start of next very year. A year after this payment has to be made, so the discounting is required, and discount factors are easy to find. 1 divided by 1.1, that has to be 0.90. Divided by 1.11 has to be 0.81, has to be 0.73. It has to be 0.66. So 0.9 multiplied by 25,000, the figure has to be 225,000. 25,000 has to be 0.81, the figure is 20250. 0.73 multiplied by 25,000, the figure is 18250. And 0.66 multiplied by 25,000, the figure is 16500. This is that simple task which I'm telling you, in most of the questions you will not be required to do. But if you will be required to do, that way is only this. That is the figure that we had all been waiting for, present value of the future cash flows. This is what one has to discount, present value of the lease payments. Noticeably, when the case is the case of advance, the first cash flow will not be discounted. Yeah, if I was working the same thing for arrears case, I would have started discounting the very first cash flow. I would have, because arrears means the first cash flow will be paid at the end of first year, a year from today. Requires to have discounting. Requires to have discounting. So this is the amount at which the step number 1 is recognized, 102500. Even you try to look back onto that word, what was the term? Present value of the future lease payments. So technically speaking, these are the future payments. And we are taking the present value of this. This is not a future payment. This is the payment that they have made today itself. So I should not even be calling that to be as a future payment. These are the 4 future payments which one has to go and find the present values of 8. You just can add this first cash flow like this as it is. Okay. Once we are done with the first step, now we will get into the second, third, fourth, fifth step, which will require us to prepare the table of lease, depreciations calculation at 31st of. Now that is standing, there will be another payment. There will be another entry, a payment of rental. Lease liability will be debited by the amount of advance payment and bank will be credited. Which date standing in of this double entry has been passed? Standing it onto the date of grant itself. They recorded the liability and they immediately have come down to pay 25,000 out of it. So liability debit, bank credit. On the date of grant itself, this is advance payment. And then I will go down to the end of first year, which is 30th of June. 30th of June, 2009. To calculate the depreciation effects and all. So process remains to be the same as I was working it first. Debit what, credit what, remains to be the same as before. Have to debit the depreciation expense account. And right of use asset will be credited. This is the value at which the asset is initially recognized. The life of the lease is 5. The depreciation expense that we have found is 202500, 20500. Okay with that? Depreciation expense account debit, the right of use asset account credited. And finally, the double entry for the finance cost. A debit of finance cost and a credit of lease liability. A debit of finance cost and a credit of lease liability. But for this, I have to go and prepare the table of lease. I can take the help of this table of lease. No, I need to draw a new one because there are lots of annotations being done there that requires to be rubbed off first. So better I should prepare the fresh one. Opening balance, rental, closing balance, interest, and final closing balance. Interest that's implicit to lease is 11%. While the first year ends on June 30th of 2009, the second year ends on 10, the third ends on 11, 12, and 13. We have got 5 years to write. We have taken those 5 years into. This is the value I am recording the lease liability initially at. You probably have seen a little bit of shift of columns. And if you have not, open your eyes, you should look into. When I was preparing the table of lease, payments were happening in arrears, which means the year has to end and then you pay. So first you have to accrue an interest for whole of the year. before the payment to follow in the very last. But now the moment the year starts, the first thing that you have to pay is a rental, which I should come down to write it very next to the opening balance. Exactly, these two columns are swapped. 102500 minus 25,000, the figure is 77500. 11% of that is 8525. The figure is 86025. This way the cycle will complete 86025, 25,000. The figure is 61025, 673 plus 61025. The figure is 67738. 42738. That figure is 4701. 47439. 2468. See, once again, I have been able to prepare the table of lease. The closing of last is becoming the opening of next year. And see what we have found into it. A balancing of, once again, 93. Which I'm telling you is fine. You will find it. There's no problem with that. The only thing that you have to see how close that last answer has turned out to be, that the last rental will come down to settle it. The contract will finish. Once again, I have been able to get the answer of finance cost from this column. Each year's finance cost is worked based on the outstanding amount. Check this out. As the way this balance is diminishing, the finance cost is also diminishing, since you are working the finance cost based on the outstanding amount each year. This is the balance of finance cost. This is the balance of liability. And once again, if I'm preparing the answer for the very first year, June 6, what will be the cost of finance for this year? What will be the liability? This is going to be the cost of finance for the first year of lease. And this is going to be the balance of the liability, but that needs to be split off in two parts, the current portion of it, the non-current portion of it, which is what I can do it once again, standing it on 30th of June 2009. The total liability that I have found is 86025. Needs to be split off in current and non-current. Now, in the case of advanced rentals, to find the current portion will also be a different process. Because in the case of advance, by standing it at the end of first year, what I expect to pay the very next day is the rental itself, which is the current liability. So if this turns out to be a current liability, the balancing of that will be non-current. 86825, 86025 minus 25,000, that has to be 6.025. 61025. while the finance cost of this year has already been spotted itself. A good question in which for the very first time you also have seen the way the table of the calculation of present value of the future lease payments I have done, which now after doing it out, you have got this impression the same way we have done the value in use calculation the last week, cash flows, discount factor, and then the present value column. The cost of finance is 8525, which is what I can come down to write it over here, 8525. Okay. If once again, if I have to go and prepare the extracts of the statement of financial position for this question, I can, this I can copy and paste so that I just can change the figures to the year, first of all, ends on 30th of June, 2008 or 9, I guess. Let me go to check. 9. All of those values have to be changed. The property, plant and equipment was initially recognized for 102500 with the depreciation of 20500. What it turns out to be 102500 minus 20500. The figure is 82,000. 2500 and 61025. While the depreciation that we have worked 20500. While the finance cost that I have worked is 8525. Okay, how many rows do I need to prepare to answer 1 year? Suppose if they've asked me to calculate the answer for this very year, how many rows do I need to prepare? This time I can safely say I only need to prepare only that year's row just. Because this time I do not need to have the liability for the next year to find me the current portion, because this time the rental payment itself is the current portion. You do not need to have the answer into the next. So for advance, the conclusion is in order to answer for any 1 year, I need to prepare only that year's row. Enough for advance, but for areas, 2 rows are required. This conclusion that you have made, you may have not been thinking of that this is important, but this is very important. Because in objective test questions, you will be having a limited time. And if you're not going to make some conclusions that how many rows do I need to prepare for this case, for that case, you may be able to get your answers right, but you may spend 5 minutes on that, which might be exhausting the time of many other questions that you can do in the same time. So take everything as important. If I'm explaining it to you, if I'm saying it to be you, you should have to have 2 questions. 4 times, 2 times I have been able to apply 4 steps. And by this time, you probably are quite much okay with the single lease accounting model. Naturally, by process, you can recall it. Okay, first step was this, second step was this, third step was this, fourth step was this. Key in this whole explanation is a table of lease. You cannot make a mess of that table by just organizing it the way that you are wishing for. Have to follow the number of columns, which has to come first, second, third, fourth, have to be having a good organized approach. And if you do not have, follow the approach I'm giving it to you. Just follow it. This is the case of advance. This is the case of arrears. The 2 of the columns exactly have been swapped. And applying the technique of calculating the finance cost on each year's outstanding balance over here also, this technique was well used. Finance cost was spotted, liability was found. To split them off, current portion is the current liability, the rental itself. Balancing has to be non-current. But for the arrears, the liability of the 2 of the years were matched. This year's liability with the next year's liability. The movement that we have found was in fact the current liability at that time. That's the extract making for that question. This is the extract making for this question. as a debit liability credit with the present value of the future lease payments. In the first application, it was given. In this question, it was not given. I had to work, which I have been able to work. Also explain to you, if the payments are happening in advance, the first cash flow will not be discounted, but the payments are happening in arrears, you have to start discounting it as from the very first cash flow. Okay. The presentation of right of use asset and lease liabilities. Presentation. See, in the statement of financial position, you should have to go and recognize the right of use assets separately from the other assets. Lease liabilities should be presented separately from the other liabilities, and you split them off into current, non-current part. That's all what we are doing. Recording the lease liabilities separately. Current separate, non-current separate. In the statement of profit and loss, interest has to come in and the depreciation has to come in. Didn't I do the same exactly for the two questions that I have done? Writing the assets separately, lease liabilities separately, current, non-current, and then in the profit and loss, I was taking that interest and depreciation expense. Even you do not read this section of your lecture notes, your job has been already done while I was doing those questions. This is the format of repayment in advance. Again, if you do not even specifically look down to this section, is this the way I have prepared the table of lease? Opening balance, rentals, closing balance, interest, closing balance. That's a sample of how the way one has to prepare the table of lease for advance, which by taking this question directly out, we have done it. But I always have this tendency to go back to lecture notes to show to all of you the way things are written back into your lecture notes. Let's look into this question. Illustrative example 8.1 from the screen itself. It's readable from there, so there's no paperwork is required. On 1st of Jan, Broughton enters into a 3-year lease. This is the date of the grant. Rentals are 10,000 payable annually in arrears. Oh, the lessor does not provide incentive to Broughton and no initial cost was incurred. The interest rate implicit to lease is 5%. See, they're working the discounting. Aren't they using the rentals to be the cash flows of 3 years and they're discounting it off at the rate of interest? Because the payments are happening in arrears, so the very first cash flow is discounted in. Remember, I was telling you off in that question that if the arrears case was involved, I would have discounted the very first cash flow. Like in this case, they have started discounting the very first cash flow. This is how the way the present value of the future lease payments one has to find. You have seen it. Right of use asset account debit, lease liability credit. Step number 1. What will happen in step number 2? One has to depreciate. Right of use asset will be depreciated based on its lease term 907. Debit the depreciation expense account, credit the right of use asset. Is there any new thing going on? You may have thought of that these questions have got something coming to your way, but this question is nothing except after practicing those two questions, it's just readable. Then they are preparing the table of lease. Opening balance, payments are happening in arrears, so the interest column comes first, rental columns next to it. And that's how the way the table of lease, even we have prepared it, they even have prepared. And then they are presenting it. Statement of financial position, right of use asset has been recorded to be the part of non-current asset, while the non-current liabilities and current liabilities are taking the liabilities of leases in. While the statement of profit and loss has taken what in? The two things, the depreciation and interest. So much readable. Same question, which we could find it difficult to read it before I had done these two questions for you. After that becomes so easy to go over to one example to the next and next to next. Refer to answers in learning example 8.3 and 4. In each of the calculate the current and non-current liabilities at the end of first year. Oh, that's I already have done. Two of the examples we have done, this one and this one. They want us to calculate the answers of current and non-current liabilities at the end of first year. That is what I have already done. So this example is already been done. I already have been able to work the current, non-current liabilities at the end of first year. For this question also, and also for this question in the past, haven't I? Literally, we're covering everything. This question comes to our way. We can have a look from the screen itself. Illustrative example 8.4. Let's see what this question has to offer. Burley acquired an asset by the way of finance lease on 1st of January 2008. That's the day of grant. That is the day of the grant. The lease contract required 8 payments of 20,000 to be made 6 monthly, starting on 30th of June. Oh, this is new thing. So far, all the questions we have done, the payments were annual. We now see the payments are happening in 6 months. Means 1 year has got 2 payments to make. After every 6 months, there will be an installment. So what if the payments are non-annual, quarter payments, biannual, monthly payments, weekly payments? Usually you are not tested onto that. But in case if it is tested, we have to have the knowledge of. Like in this question, every 6 months they have to pay 20,000. And there are 8 payments. Total 8 payments. Every 6 months they have to pay. So what is the lease term then? If every 6 months they have to pay 20,000 for 8 times they have to, then how many years they will take to pay 8 payments? If 1 year has 2 payments, then how many years will have 8 payments? Mathematics. 4 years. That's the lease term. 4 years. Each year has 2 payments. So 4 multiplied by 2 equals to what? 8 payments. This will create a disturbance now. Payments are 8, lease term is 4. In the past, payments are 5, lease term was 5. Easy. So when the payments are 8, lease term is 4, how many rows do I need to plan into a table of lease? Because situation was easier before. 5 payments, 5-year life. So 5 rows, 4 payments, 4-year life, 4 payments. The 6 monthly interest rate implicit in the lease is 7%. They have provided us with the rate of interest also. And the present value of the lease liability at the start of the lease was 119,427. They provided us with the present value. That's not an issue. In fact, the same value they have used to write the lease table with. Is it or not? The year end is December 31st. Okay. The payments are happening in advance or arrears. The contract was signed on 1st of Jan. And they are going to pay the very first installment on June 30th, which confirms to all of us the payments are happening in arrears. The payments are happening in arrears. And that's the reason why you look into a table down below, the interest column has been taken first, repayment column has been taken after, which confirms to all of us the payments are happening in arrears. But still the actual problem is there to talk about. The actual problem is how many rows do I need to prepare? 8 rows, just because we have 8 payments, or 4 rows, just because the lease term is 4. So my answer is 8 rows. Every row will take its own payment, and there are 8 payments. So 8 rows, as simple as that. Let's see if they are doing the same in the solution or not. Each year's finance cost is based on the outstanding amount, which is what they are working. Did they prorate this amount into 6 months? No. If I try to multiply 7%, 119,427 multiplied by 7, the answer is 8360. They haven't multiplied this amount by 6 by 12. Because the 7% rate of interest, it's already a 6-month rate of interest. It's not annual rate. So the figure that they have got is in fact the figure of 6 months itself. No need to prorate this into 6 months. Everything has to be looked into that by your open eyes. Each row has got 6 months. Check this out. Do you see, first of all, written the 6 months thing in it? Do you see the date that they have mentioned? Is this the end of the year? No, that is the end of the first half of the year. This is the end of the year. So in fact, the 1 year will have 2 rows. Each row will have its own 20,000, 20,000, 20,000, 20,000. So we are going to prepare 8 rows. But obviously they haven't prepared, since, like I told you, that you should have to stop yourself at respective number of rows rather to waste the time in completing the table of lease. So they have not completed the table of lease, but that's continuing. Since every row has got 6 months, 30th of June, 31st of December, June 30th, 31st, and the 2 rows will make the 1 year. While the way the table you have to prepare the same way as if you're preparing it for the year, closing of 6 months becoming the opening of next 6 months. Finance cost is work based on the outstanding amount they see at the start of this payment minus this. So this is the balance that they see at the end of first year. This is the answer they see at the end of second year. Now, in order to find the current portion of it, what is the change that we have seen? It's area. So we have to compare the liability at the end of first year with the liability at the end of next year to find the current portion, which is going to be what? 95332 minus 67745. The figure turns out to be 27587. 27587. Is this the same answer we also can see being worked? Check this out. If in the solution they are recording the same thing as current liability or not. Exactly the same. 27587. They have been able to work it out as a current portion. And this is going to be the finance cost by adding the two figures. This is going to be the finance cost for this year, which is going to be 15,000 something. Exactly, they have done the same. First 6 months interest, last 6 months interest, total finance cost for this year is going to be 15,905. If this portion turns out to be the current one, the balancing will have to be a non-current. So overall, same, but a little bit of confusion that was there to see how many rows we should have to prepare. So the answer was pretty clear. For each payment, you have to have a row. So how many payments we have? 8. Make the 8 rows. 1 year will have 2 rows. First row will only have 6 months. The second row will have second 6 months. While the way the table you have to prepare the same way, deduct the rentals. Closing of last becoming the opening of next, work the cost of interest. No need to prorate the interest cost. I already have told you, because that 7% is already a 6 months interest rate. They had not completed the whole table just because I told you that the respective number of rows are required to be prepared. No need to waste the time, but really the way they are preparing, it's giving us that confirmation that it's 8-row table. So where the need is there, I am solving it out, every possible thing, but some of the stuff can be done by this way, which nicely I have done the whole operation of that in front of all of you. The whole surgery of the question, I have done it in front of all of you by labeling it, by explaining it. Okay with that? So you see that the time that we have been spending it over to this method, you also can feel it like it's a method that where the investment of time has to be there. And we already have invested a lot of our time onto the single lease accounting. And next to that, simplified accounting is starting, which we already had worked. After that, there is a sale and lease back topic. We will be doing it. Afterwards, that's something else. Moving back to work, what we have not yet finished, it's the discussion of the measurement of right of use asset. We had been focusing a lot on the lease liability, lease liability, lease liability. But now we will have to shift a little bit of focus towards how to measure the right of use asset. How to measure the right of use asset. This is in fact the explanation onto my notes next to it. Check this out. The measurement of right of use asset. You clearly can see being the next explanation also onto my side. See, everything has possibly been scanned up that we could. Nothing's being left that can further loop in examples, questions, illustrations, text, whatever is there. I have been able to look into that thoroughly. But we are moving back to few of the explanations that we could not finish it as of yet. And that is the explanation of how to measure the right of use asset. Initially, let's go to understand that from our own explanation before we head back to the study text, head back to the lecture notes to see the things are written there. The first thing that we have to take is the present value of the future lease payments. Present value of the future lease payments. You will be wondering what's new in it, because that is what you people have been doing it so far. Present value of the future lease payments. Didn't you see me recording the step number 1 at this value? So yes, totally agree. Basic thing will remain to be there. We are not going to talk about lots of other items that I need to top it up into the basic value. Basic value, you remember step number 1, right of use asset account debit, lease liability credit, the present value of the future. So that is going to be there. Obviously, I'm going to talk about some further things that might join into that basic value. Let's pay attention to that. So this is fine. We all know this. What is the next thing? Initial direct cost incurred by lessee. For example, the legal cost, lease arrangement fees, processing charges, any cost that has been incurred by the lessee at the start of the contract will be capitalized. The word initial is used. Why the word is initially used? Why the word? Because this cost has been incurred at the inception of the contract, at the start of contract, at the inception of the contract, at the start of the contract. One-off in the start. Legal cost. May have incurred the legal cost in arranging the lease, in negotiating the lease, in processing the lease. If the cost has been incurred by lessee at the start of the contract, we will be able to top this up in initial direct cost incurred by the lessee. This cost might have been incurred by the lessor. You have to see who has incurred this cost. So if that cost is being incurred by the lessee, we have to come and top this up into it, as I have. Payments before the start of the lease by the lessee. What is this thing? Payments before the start of lease by the lessee. We are talking about the deposit. Any sort of deposits. If the lessee has paid over and above to the rentals to be paid over the life, deposit is the one-off payment at the start of the contract. If the lessee has made, we will top this up. So examples are there to explain. Rather you cram the whole sentence, you can keep that in mind. Okay, deposit will be topped up in it. Legal cost will be topped up in it, because this cost would have not been incurred by the lessee if the contract was not arranged. So that's directly attributable to the contract of lease. We need to top it up in. Future site restoration and dismantling costs payable by lessee at the end of lease term. Future site restoration and dismantling costs payable by the lessee at the end of lease term. This discussion is, in fact, we have done it also before while discussing the property plant Negoprint standard. Today, if I am fixing the plant, installing the plant, preparing the site to install it, after 10 years, once the lease contract will expire, I will have to go and dismantle the plant, and I will have to clean up the site. So all the costs, because we are expecting to incur in future, the word future is used. Future restoration cost is a cleanup task. Dismantling cost is an unfixing, uninstallation. Payable by lessee at the end of the lease term. will be topped up into it, as it has been topped up back into a topic of property, plant, and equipment. Let me come down to see if any one of you, or all of you, or some of you, whatever, not making the sense what I am talking about. Let me take you back to that summary of I-16. The very first standard of our course was I-16. When I was discussing the cost therein, I did explain this to you, this thing over there also. Check this out. Future site dismantling and restoration cost. Same explanation. The way it was becoming a part of property, plant, and equipment, the same way it will become the part of the cost of right of use asset. Asset is asset. May you have purchased it or may you have taken it on lease. The costs associated to that are going to be incurred, capitalized the same way. Lease incentives being received by the lessor. There could be some kind of incentives if the lessee has received from the lessor. We must have to offset it. That's the only one item we are deducting it from. Well, the rest of the items are all there to top up. This is the final amount at which the right of use asset will be recognized at. This discussion looks bigger, but actually not. We have one question on which to apply this knowledge. This question is learning example 8.1. It's just taking a space, but actual thing is table of leases, single lease accounting model. This part of the explanation only looks bigger, but when I will solve this up, you will be like, okay, that's fine. There's nothing so much to worry about. What general entry is required to recognize an asset? A acquired a new asset by the way of lease on 1st of January 2008. A date of grant. The asset had got the fair value of 135500. And the lease contract required to have 4 payments of 40,000 to be made annually in arrears. Annually in arrears, 40,000. The implicit rate of the lease is 7%. And the initial measurement of the lease liability is 135,489. Oh, they have given the present value of the future lease payments. Perfectly fine. If not given, we know how to find it. A paid 2,000 in legal cost associated with the lease. Oh, that's the initial direct cost I was talking about. A is making the payment of that. And the lessor has agreed to pay 3,400 charges payable to an external company to deliver an asset to required location. So it's a lessor who is taking the responsibility of increasing the cost of delivery. That's a lease incentive. The leased asset will be used to dig underground to identify the existence of mineral deposits at specified site. At the end of the lease contract, A is legally required to pay to restore the damaged land. Now, this is future site restoration cost. The expected cost of restoration work has got the present value of 12500. So it's like we have been provided with different parts and we have to bring them together. Like it's a puzzle which has got different portions, and you have to assemble it to form the cost of an asset. So it's taking a bit of space onto this page, but literally I'm telling you, it's more easy task because I just have to bring those 4 to 5 items together to find the total of it. Job will be finished. It's not as difficult or time taking as the table of leases we had seen before. You will see the first thing that I have to write is the present value of future lease payments, which is what they have provided to all of us. What is provided to all of us? 135,489. 135,489. A paid 2,000 in legal fees associated with the lease and is incentive to A. The lessor agreed to pay 3,400. Sorry, 2,000 has to be the legal cost. I need to top it up in. I need to top it up in. And there is a future restoration cost. The restoration cost is 12500. And this is some sort of lease incentives we have got. 3,400. 135,486, 2000, 12500, 135,486 plus 2000 plus 12500 minus 3400. The figure turns out to be 146586. It's only this task. This is the value at which the right of use asset one has to initially recognize, and I can go to pass the double entry for that. I mean, out from that large question, we only have to do this. Bringing all of those components at one place and finding the total is an easy task. It's nothing except this. Once I told you, look, you have to take these components, just join them together if given. Whatever is given, you may not see all the components will be given in one question. Like in this question, we are not provided with deposits. We only have initial direct cost, restoration cost, and lease incentive. So whatever is given, just bring all of those components together to find the total of that. It's only this task. You can clearly see what I'm talking about, why the lease tables and all that explanation of having it before has taken a lot of time, requires to have more of our attention. Let me go to pass the double entry to end up the whole question, because this question requires us to pass the double entry. So I'll have to debit the right of use asset account. For surely have to debit the right of use asset account, which is 146586. 146586. On the other side, lease to credit the lease liability account by the figure of 135489. 135489. And then we'll credit what? The provision for the restoration cost. Provision for the restoration cost 12500. And what will be credited? A bank. Right of use asset account debit. Correspondingly, there are 3 credits. Double entry is all balanced. Now, one thing that needs to write it is the cost of delivery, which on the up, I will go to debit it by the double entry is all balanced. Key thing to notice is that the lease liability will still take the present value of the future lease payments. Whatever the discussion is happening on, it's all in regards to right of use asset. This will have no effect onto the lease liability balance. Lease liability will still take that basic value, present value of the future lease payments. I will be taking the same amount into a table of lease to prepare it, which in this question, I'm not preparing it, but we know how to prepare it, this table of lease, so nicely. We know how to prepare it, this lease liability table. We have to prepare it the same way: opening balance, interest, rental payment, closing balance. Point that you have to remember, whatever the value we have been able to assign to right of use asset by using these components have got no role to play while working the lease liability. Lease liability will still take that basic present value of the future lease payments to prepare the table of lease. It's only the right of use asset that's taking this whole addition subtraction task, which is what in this question I have been able to pretty much apply. Just the same way, back into lecture notes, it's written initial measurement of lease liability, which is the present value of the future lease payment. Lease payments being made by lessee before commencement, which is deposit. Initial direct cost by incurred by lessee, future site restoration, dismantling cost, and lease incentive received. Ownership does transfer, does not transfer. This is the explanation I was doing it. When ownership does transfer, you take the useful life to depreciate. When it does not transfer, you take the shorter of 2, useful life and lease term. All from there, I make those summaries from that. Later, it becomes so easy for you to read. The discussion of lease term is non-cancelable period for which the lessee has been given a right to use it. Remember, the period of extension and period of termination, where lessee is likely to extend, where the lessee is not likely to terminate. This was the explanation I have had it in the first most initial part of the topic. All from here. Let's do the one last question of today, and we'll leave whatever the part of this lease topic is left for the next course. Learning example 8.2 will once again be a revision of this calculation, which is an easy job. Learning example 8.2. On 1st of June 2007, what accounting entries are made in the years ending on December 7 in respect of lease property? So my year ends on 31st of December 7, starts on 1st of Jan 2007. On 1st of June 7, Rosal acquired a property by the way of 10-year lease. This is the date of grant. The present value of the lease payment at this date was 990,000. So they've given that present value of the lease payment, excluding a deposit of 50,000 being paid by Rosal. Deposit is a payment before the start of the contract. Rightly so. This is the day the contract was signed, just a month before they have paid that deposit. So let me go and make the list of the same stuff one more time. The present value of the future lease payments, topping it up by the amount of the deposit that they have paid. So that's about 990,000. Deposits are 50,000. Rosal incurred 40,000 in legal fee associated with the lease. Now this is called as direct cost. Legal cost, 40,000. Rosal owns the number of properties. It comes to using the valuation model. It has elected to apply the model to the lease property also. So they have been applying a valuation model to other assets. They also have opted to apply the same model to lease. At December 7, the fair value of the property was 1180. It has the, so we will do this valuation. At least we don't find restoration costs. We don't find lease incentives. So the answer that is going to be the final one for this will be 990 plus 90. 1080,000. 1080,000. So with this, I will have to debit the right of use asset. We'll have to credit the bank account with the payment of 90,000 and we'll have to credit the lease liability. A debit of right of use asset and a credit of bank and lease liability. A debit of right of use asset and a credit of bank and lease liability. The double entry is pretty much balanced. This is that balance, like I'm telling you, we'll go to prepare the table of lease with, which obviously right now we are not having a focus on preparing since we already have prepared it for about 3 to 4 times today. But just explaining to you of when you will go to prepare the table of lease, you will use the same amount to prepare it. This will be the amount the right of use asset will take for the purpose of depreciation and all the valuation, which is what we can do it. Which is standing it on its all happening. That day is 1st of June 2007, and it has got how many number of months to run from the day the year ends? June, July, August, September, October, November, December. We have 7 months. Yeah, 7 months. So by the time the year will end, 31st of December 2007, we will go to depreciate this. What has been recognized? 1080 for right of use asset, 1080,000. The life of the lease is 10 years. Is it 10 years? Is it? 10 years. And I need to take a charge of 7 months for this year, as I have noticed, 7 months. This is where the basics of accounting will come into play, the 7 by 12. Why we are using it, this is what we know from our depreciation topics, not the topic of lease explaining us to use that 7 months factor with this. So whatever the depreciation answer that I have got, multiplied by 7 divided by 12 gives us the figure of 63,000. This is the charge I have been able to work. With the double entry of that, I can write it. Debit what, credit what? Depreciation expense account debit, and the right of use asset account credit. A debit of depreciation expense and a credit of right of use asset. What will be the carrying amount? The asset on that day in the books will be carried out at 10800, no, 1080, 000, 1080, 000 minus 63,000. So this is the carrying amount at which the asset in the books will be carried out at 1080, 000 minus 63,000. The figure is 1017,000. And now we will have to see the revalued amount. What is the revalued amount that they have provided us? This is a valuation thing now. We can do it by keeping the knowledge of valuation. Did we find the valuation surplus? Yes, we have. What is the surplus that we have found? 1017 minus 1180. The figure that I have got is 163,000. This is what I will go to record it into OCR. So valuing the right of use asset takes the same process as you value a property plant, working the depreciation first, calculating the carrying amount, comparing it up with its revalued amount to find the gain and loss. Has got the same old story. Well, finding the value of the right of use asset is in fact the topic of the moment, which you try to be honest to yourself is something to worry at. It's nothing except making the list of all those items and find the total. These items, just to write it, it takes more space on the page. So it looks as if we are doing so much tough task. Where the real task is still preparation of tables of leases, splitting the liabilities into current, non-current, and decorating them onto the face. Such a nice way we have been able to finish whatever we thought we could finish it. I thought I could finish it. Only the one part of this chapter is left to work, which we will work the next time when we will meet up, the sale and the lease back contract. Such a massive, huge, important chapter we are in discussion of, but 80 to 90% of discussion already finished. The sale and lease back can take the next course further 1 hour with the practice to take. I still expect 1.5 hours. The next week, we will be spending the time on before we will be able to start off with chapter 9. So session after session, we are finishing the chapters, the reporting standards. From my side, we are taking the live courses by coming into. From my side, you get the whole board works into the PDF, the recordings of that the very next day. From my side, everything is in so much disciplined manner, the way I had promised, the way that I do things each time into courses, with no exception. I do not know at your side by how far are making the use of those resources and making the use of those resources into your daily lives. Better to keep that with you into your daily life, into the last rather. I've said this to you many times when you try to pile up the things to the last month, even though you have got everything with you, but sometimes it becomes difficult or impossible, I would rather say, to manage the time out to do it all. And you feel it like, okay, I should have listened to my lecturer when he was saying it right through the courses. I was not listening to. I was always having lots of excuses left and right. But I was not really getting on to the point that if I have to qualify this paper, I have to find a time out from to my busy life in a much more disciplined manner, which I did not listen to my lecture. And today I am literally regretting. I know I have everything, but I don't have a time. Do I go to watch the videos, or do I have to prepare things at my own side? I only have got a week or two left. I do not know what to do. There are too many things to do. This is the situation you will be on if you will not continuously making the use of the resources and making it available to you in the courses, of the courses. You should be respecting that. I gave you the one simple example in the starting courses. I do not know in this course, I have too many badges, that if you take all the meals of the day at one time, will you be able to digest the whole? Even you will not be able to swallow all into it. Why? Because you go against the nature. Similarly, you sit there into a month of May trying to put everything into your mind. Your mind will not accept it. Blast. You will forfeit. You will see that, okay, I will see next time around. And next time you will do the same mistake. Unless or until you will not realize that continuous effort, week by week, lighter explanation, what we do, revise it, come to visit the board work, the recording, not the whole recording. I want you to go and watch it, but parts of it, just try to pause it and see which part. This way, at least you will be confident like that I'm with my course. I'm making the use of all the resources that I have paid for. And in the last, I just have to go and practice, revise. This much effort, at least I require from you. Already the 7 weeks are gone. Still, if you have not yet started thinking of it, the next 13 to 14 courses will even pass like this. You will not realize the time will expire. So that is the course of today. We will see into the next course of Saturday with the topic of same. Please, like I always say before leaving the course, come up with a revision of whatever we have done today, so that when you meet me the next time, you will be in the same flow that right now at the moment you are. Have a good day. Thank you very much.